Hello traders, this is Dan from Master Trader. We have a number of great option trades for you this week and just wanted to give a little audio description of this particular play, particularly since we have been getting a number of questions about our strike selection on a number of our calls. We have a terrific track record on selling the out-of-the-money credit spreads. And today on JP Morgan, we're going to give you a bearish vertical spread. So we wanted to just show you the chart and the methodology of our trade selection today. JP Morgan here, very bullish breakout after the Trump election, along with the entire financial sector. After consolidating for a couple of weeks, after a false breakout last week, it gapped down on earnings, has a bearish consolidation. Even though the financial sector is a little bit oversold now, there's many similar looking charts, but we like this one the best for lower prices. So we want to put on a bearish trade, or what we refer to as a mildly bearish option trade, because although it does look lower, possibly with a target to the lower 80 on this prior breakout area, it's not going to fall apart. It's not going to fall all the way back down to the $70 breakout range, in our opinion. So we want what's called a mildly bearish trade. So here's the option trade quotes on the put side. And with JP Morgan closing at 83.66, we want to buy an in-the-money put. So that way we pay less time value. As option sellers, as you know, we want to sell time premium, particularly when volatility is high and option prices are overpriced. When we want to place a directional trade, and with option premiums low, we want to do an in-the-money, on the bearish side, a bear put spread. So therefore, we want to buy a put higher than the current strike price, which in this case is the $87.50 put. Time premium is around 40 cents or so for the month of February, so that gives us a full trading month for this trade to work, even though it's just a swing trade to us. And since we are not very piggish, if you will, on the downside target, low 80s would be a terrific trade. We're willing to sell the $80 strike out of the money put to bring in additional premium to offset the cost of the long put. So what we've recommended in the letter, and I'll show you here on my toss platform, this is Thinkorswim. So I would load up, my default is a 10 lot, $87.50 put, purchase, and I'm selling the $80 February put. That is a bear put spread, and as you see here, the net debit of that is $3.64 a share. So I've lowered my cost basis instead of just buying the long put alone. Then I would hit confirm and send the trade. Once it at the midpoint, this automatically loads up the midpoint of these two particular strikes. So once the JP Morgan IFIC trades under the lows this coming week, I will be putting on this trade myself, and that I hope gives you a better understanding of one example of how we do the strike price selection. Hope that helped. Have a great week, and keep the excellent questions coming in, and congratulations for the great trading results from all of you. Take care.